Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring. Today is Saturday, April 20th, 2024. How you doing? I hope you're doing well. I hope you're having a good Saturday. Appreciate you coming to my weekend review podcast. Boy, last week was a big move down. Big move down. Volatility has really picked up in this market. We were quite overbought. And, over the last few podcasts, I did keep reiterating that the technicals were showing that we were running out of buyers, and that did come to fruition. But at this moment, we have some things on sale, and we are coming down into some interesting levels on quite a few markets. So I will go through and point those all out today. But thank you very much. Appreciate you investing the time to listen to this podcast, and I hope it is going to be helpful for you. Uh, the format for the podcast today is first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all of the different positions that I have. We're going to talk about when I entered them, why I entered them, what was the strategy, what was my thinking, where were going to be my stops, what were the confluences and combinations of indicators that had me take the trade in the first place. And then we're going to talk about, most importantly, how I am going to manage the trade going forward, whether it goes my way or it goes against me. When you take a trade, the way that I look at it is I want to look for as many confluences and combinations of indicators lining up to show me that, okay, the place that I'm taking the trade makes sense. And then if I'm wrong, that I'm wrong small. That's really the key with trading, is looking for those levels that line up, making your decision, position sizing correctly based upon the market volatility and the amount that you have in your trading account, and then putting the position on. After that, you have no more control of anything. You do have control of entry. You do have control of how much to enter. But once you do that, then it's in the market's hands. But you have to have a process that tells you what decisions to make regardless of what the market does. And you're not always going to be right. I'm wrong all the time. The difference is when I'm right, I'm generally a lot more right than I am when I'm wrong. And that's the key to profitable trading. Good risk to reward ratios, being very impatient with your losers and being very patient with your winners, and having a process and a set of rules that tell you, okay, it's doing this, so I'm going to keep doing this. It's doing that, I'm going to keep doing that. So it's very, very important that you have a process that tells you what to do at all times. You have no idea what the market's going to do, but you have to know what you are going to do at all times. And that is what I will show you when we go through the current positions that I have. And I'll say, if it does this, then I'm going to do that. If it does that, I am going to do this. But yeah, really, really interesting week in the market. But like I said, there's some things on sale right now. And, stocks and other markets, interestingly, people always tend to want to buy them when they're fully priced. When they go on sale, they're like, ooh, I don't know, that's pretty scary now. And no, I get it. I get it for sure. But time after time after time, when you go back through the market, buying when it's scary generally tends to be the right decision. And buying when things are going up very, very strongly, if you look back in time, that's not the right decision. So it's always counterintuitive. All right. So after we go through the positions and what I'm going to do with them and how I'm going to manage them, we're going to talk a little bit about trader psychology. It is the most important skill in trading, everyone, the ability to create a plan and follow the plan. But the psychological aspect gets in there and messes with people's heads. But get yourself a plan, follow the plan, and it all comes down to trader psychology and whether or not you can do it. So I always like to talk about trader psychology. It's helpful for me to teach, and I hope it is helpful for you. I hope that you pick something out of it that resonates with you and that you can implement in your trading. After that, I have gone down through my master watch lists, both on the daily time frames and the weekly time frames. And I have identified some potential markets for next week that I am interested in. They are not at the levels yet that they need to be for me to become interested. But if they do, I will definitely next week consider um, entering these positions. And, I have a handful, more than a handful, I guess, on the daily. I have one on the weekly. Like I said, they're not there yet, but if they do get there, I will consider them. And the real key in trading for the way that I trade and how I approach trading is, even if I have, you know, 3 or 4 or 5 different signals or markets um, trigger on Monday, I'm still only gonna take one trade. I'm gonna take the best trade. And how do I do that? Which I have to decide between the candidates, which one has the best which one has the best risk to reward ratio, which one has the best confluence of signals, which one looks the best on multiple time frames, which one has the best relative strength. All right, so it's kind of a process of looking through and dialing into the best setup of that day, and that is how I approach it. So um, like I said, for weeks, I have not been buying a lot of things because I just felt strongly that we were too high. But there are some interesting levels coming up here on big major stocks, on big major stocks. So we'll go through that, and I hope that will be helpful for you to get an idea of what I do on the weekend and how I identify my potential trades next week. But I'll get into all the levels and what I'm looking for and so forth and so on. And hopefully that's going to be helpful. And if it is helpful for you, and if you do find some value at any point during this podcast, I would appreciate it if you could hit the thumbs up button or subscribe. It really does help the channel, lets YouTube know there's some valuable content here. So, all right, well, let's get started. Let me run the U.S. legal disclaimer. We'll get that out of the way, and then we'll come back and we'll get rolling. All right, so hang tight for about 42 seconds.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. All right, first of all, we're going to go through the daily trades that I'm in or that I'm not, or that I exited last week. Let's start with PayPal. All right, PayPal, I did get short on PayPal here on the 8th of April at 66.50. Okay, so the trade is doing quite well. We'll get into more of that later, but the real question is, why did I get short this market? Well, you can see this highlighted blue area in here. This is what's called a fair value gap. A fair value gap, what you want to look for is you want to look for a high, a little bit of a pullback, followed by a higher high. This is called running liquidity. And then you want to see a big, strong move to the downside that takes out the first swing low. Once that happens, that changes the market structure from a bullish market structure to a bearish market structure. And after you change to a bearish market structure, generally you will have another rally, a counter trend rally back up into a fair value gap. This is taught by, oh my gosh, I can't remember right now. I'll think of it in a minute and I'll let you know. But this is not something I came up with, but this is something that I follow that I really like, called fair value gap. So high, pullback, higher high, ICT. Check out ICT on YouTube, ICT. And I have incorporated this in my training, and it really quite good. So again, high, pullback, higher high, followed by a strong emphatic move down that takes out the first swing low that changes into a value gap. Then you have you use 3 bars to identify the fair value gap. Bar 1, bar 2, bar 3. You have a low, or the low of bar 1, the high of bar 3. This is what is considered the value gap in the blue area. So I was waiting to get to the top of the fair value gap because it would give me the best risk to reward ratio. I did get short 66.50. At this point, I position size correctly. Then I have to have 2 stops. I have to have, oh, that other one was right up here. Sorry about that. I deleted some stuff on my chart. There we go. So I have 2 stops now when I enter the trade. I have an end of day stop, which is simply if we close above the high of that previous high, that would change the market structure back to bullish and I would get out. And then I have my emergency stop, which I have on all trades, which is 2 ATRs from entry. Very rarely do I hit this emergency stop, but if I do, then I lose 1% of my count. Only about 5% of the time do I ever hit this. 95% of the time, I'm going to get out with an end of day stop. So let's go back over it again. We have a high with a pullback, higher high, move back down that takes out the first swing low. This changes it into a bearish market structure. I'm waiting for a check back into the fair value gap. I did get short here, 66.50. End of day stops, close above that previous high. Emergency stop, 2 ATRs below, above that. So whenever I get into a trade, long or short, I want to identify 1.5 ATRs in the direction of my trade. Because I'm short here at 66.50, 1.5 ATRs below here. If I get to this level, then I'm going to go into what is called trailing stop mode. Okay, and once I do that, it doesn't mean I exit the trade. It just means that now in the future, if I'm short, if I have a close above a previous bar's close, I'm going to exit half the position. And if I'm long, if it gets to 1.5 ATR trailing stop level, then if I have a close below a previous bar's low, I will get out of half. And that really tightens everything up because now I am short. You can see here, I have reached trailing stop level. If I have a close above a previous bar's high, then I'm going to exit half. So I take half of my position away, I lock in half, and it really tightens up my stop. Okay? In addition to trailing stop level, everything I've talked about so far with the end of day stop, the emergency stop, the trailing stop level, and exiting half, these are all defensive. These are all if they go against me. But I also play offense in my trading, which means that if it moves the value of 0.45 ATRs, right now you can see the current value is 75 cents. And this changes every day, but for example, I'm short here. If it moves down again on Monday, the value of 0.75, I'm going to take another profit target. So whenever it moves the value of 0.45 ATRs from the previous bar's close, long or short, depending what kind of trade it is, if I'm long or short, I'm always going to take off half. On Monday, like I said, it's 75 cents right now. Let's say it moved $1.50. Well, then I would take 2 profit targets. So I always set 3 profit targets for the next day with value of 0.45 ATRs, and I will take off 10% of whatever remaining shares that I have. Everybody taking off partial profits, not all, just 10%. Whenever it moves in your favor, the value of 0.45 ATRs is invaluable to me. What it does is you lock in profits and you reduce your position size. So the more profit targets you hit, the easier it is to follow your process because you keep taking off some heat. You keep taking off partial positions. And as you take off and as you take off and as you take off, just psychologically, it's much easier to keep with your plan. If you have a huge position and it moves your way, you're going to be tempted just to take it, right? I got out of XLF last week. I was in that trade for over a year. It would have been extremely difficult for me to hold that position for a year to full position. It would have been great, but extremely, extremely difficult. All right. So for me, taking off partial profits takes a lot of heat off and keeps you in the mindset that it's easier to stay with your process, at least for me. Maybe some people are superhuman, they don't have to do that, but for me and many of my students and many professional traders that I know, this is very helpful for them. Okay, so again, we have a high, pullback, higher high, moved to the downside, which changed market structure to the downside. I waited for the top gap to get filled, 66.50, moved up the next day against me. It's okay, didn't close above. And then, look, we moved down, I took some profits. Next day, we moved down, I took some profits. Moved down, took some profits. Moved down, I think I hit 2 profit targets here. Nothing here, here, here. On Thursday, moved down strongly, took some more profits. And right now, this particular trade, this particular short, doing very well. Oops. Up 6.66%. That's a creepy number. But that's it. And we are at trailing stop level. So now, let's say Monday, we closed above a previous bar's high. Then I would just take half of whatever remaining shares that I have. Remember, I don't have the full amount because as it's been moving straight down, I've been taking profits. So I have fewer shares than I had when I started. But let's just say I started with 1,000 shares. Let's say I have 500 shares now, for instance. If I get a close above a previous bar's close, I'm going to take 500 down to 250. Okay, then really the heat's off. All right. Now, if we go down lower, if we get into if at this point, if I get to a 35 RSI level, well, then if I have a close above a 5 EMA, I'm simply going to get out. If I reject the 30 RSI, I would take half of whatever remaining shares are. And then if I have a close above a previous bar's close after rejecting the 30 RSI, then I'm completely out of the trade. All right. And then earnings is coming up here on the 30th of April. Regardless of what happens, I will get out of the position before earnings. I never hold through earnings. And so, it seems like I have a lot of rules here, and I do. I've been trading for over 28 years now as a full-time trader, and I have those rules for my protection and to make money. And I do teach private one-on-one lessons in the evening time via Skype. So if you're interested, it's a great course. I have taught people from all over the world. I think from absolute beginners all the way up to the hedge fund level, and everywhere in between. I love to teach. I believe I've been told by all my students that I am a very good teacher. It's very important for me that my students trade well. And so I will teach you everything I know, have a very formatted course where we go through everything. I explain all the rules. We do lots of simulation trading. And when you're done, you are going to be a much better trader. And like I said, I'll share everything with you that I know and be a good trader. So if you're interested, my email is in the link in the description. Just send me an email and we'll get the conversation started. So, okay, PayPal, like I said, current remaining shares up 6.66%. So it's been a really, really good trade. TLT. All right, bonds. All right, well, you've heard me talk a lot about island reversals and abandoned babies lately. It's one of my new favorite trading approaches. I've been using it for about 6-7 months. It's very, very powerful. And if you'd like to learn more about abandoned babies and island reversals, just go to my YouTube channel. You will see that I have a video there on abandoned babies. And they really are very strong. They don't always work, obviously, but they work more than they don't. And if you have a winning trade with this, you make more than you lose. So they work more than they don't, and when they work, you make more than when you lose. Well, that's good trading. Okay, you see the blue shaded bar here. Why did I shade this bar? Well, you can see the bar before we gap down. So there was some bad news in the market for this particular market, TLT, and then the day after we gapped up. So we went essentially from something bad to something good as far as the market perceived it. When do you see how this little bar here is hanging by itself, gap down, gap up? Well, this creates an abandoned baby. They call it abandoned baby because it's just like a little baby here by itself. Gap down, gap up. When you have these sudden shifts in sentiment from bad to good immediately, it's kind of giving you a clue that maybe something has changed. So with these particular trades, with abandoned babies and island reversals, when normally, like I just mentioned on PayPal, I phase out, I have a trailing stop level, um, I have all these different rules. But on these particular trades, because I have found that they are so strong, I simplify this trading here when I have an abandoned baby, and I just say, okay, if I lose, I'm going to lose 2 ATRs, or in other words, 1% of my total account. But if I win, I place my profit target 4 ATRs above. So 2 ATR stop loss, 4 ATR profit target. Well, that's good asymmetrical trading. If I win, I'm going to win twice as much as if I lose. And as I mentioned, with abandoned babies and island reversals, they tend to win more anyway. So there is your edge. You have to have an edge that says, okay, with this particular setup or this particular pattern, it happens to go this way more than it goes that way. Doesn't mean it's going to do it every time, but let's just say let's just say if you did the back testing on an abandoned baby, in my experience, it's about 70% of the time, maybe a little bit more, where it goes your way, and 30% of the time that it goes against you. So if 70% of the time you make twice as much as you lose, that's a pretty good proposition, isn't it? So what I'm saying, just in my experience, that this signal, this abandoned baby, 70% of the time I'm going to make 4 ATRs, or 30% of the time I'm going to make 2 ATRs. Well, that's something to consider. Okay, so we gapped up here. It moved up, then it came back down to the top of the abandoned baby. In my experience, sometimes it can gap way up here. And then you have to decide, well, I don't know if I want to chase it there. And a lot of times I don't chase and then it just keeps going. But what I like to see is I like to see the gap up, then the pullback to the top and basically fill the gap. That's all, really all it is. It's basically filling the gap. And that's exactly what I did. I bought here at 88.52 on the 17th of April. My stop is 2 ATRs below. My profit target is 4 ATRs above. And this particular trade right now up 0.68%. So not doing too bad. Not doing too bad. So I think that's all on the dailies. No, those are the two open positions. And then on Apple, okay, so I was talking about structure changes, the short structure change on PayPal. Well, this was a bullish market structure change. This one did not work, but it's a good example to show you this is the opposite. Here we have a low, then we have a rally, and we make a lower low. Would you agree? As soon as that happens, I look to the left and I find the most recent swing high. It was right here. This bar here took out that swing high, and emphatically, this changed the market structure to the upside. I didn't chase it up here. I was waiting for the fair value gap to be to present itself, and the fair value gap actually was all the way from here to here. This was a very large fair value gap, but I bought when we came back to fill the gap. I'm really glad that I was patient for it to come back down, because this was a very strong market structure change, and it just failed. But so I did get long here on the 16th of April at 169.10. Gives me a good risk to reward ratio, and I was very surprised. Of course, you know, the market this week was very, very volatile. And then my stop, my emergency stop, 2 ATRs below, and my end of day stop was simply a close below this low, because if we close below this low, then the market structure goes back to bearish. Well, this happened on Thursday on the 18th of April, where it just closed below that low. I exited the position for a loss of 1.34%. Which is, you know, it's never fun, but it's a small loss. But the more important thing is that I remember at the end of the day, right at the end of the day, it was, the stop was what, 11, right? Yeah, 167.11. It was 08, 09, 10, 11, 08, 09, 10, 11. And you know, you kind of want to keep in the trade. You want it to hold above, but it closed below. And so I held my nose, hit the sell button, and good thing that I did, because look what happened on Friday. So not all gains are going to be winners, but the most important thing is that if you're wrong, and you're going to be wrong a lot, I'm wrong a lot, that you're wrong small. And if you're right, that you're going to be right, you're going to be right big. And so I did take a loss on that for 1.34%. So the recap on the daily trades, of course, my short position on PayPal up, because I'm short, up 6.66%. TLT, the gain, currently up 0.68%, and my close position on Apple down 1.34%. All right, let's go over to the weekly charts. I do like to trade both daily and weekly charts, and also monthly charts. I think it's very important that you have different time frames. One time frame may not be working out for you, but the other ones might. And with my trading, the three tenets of my trading are: I want to trade as many different markets as possible, not just tech, not just equities. I want to trade gold and bonds, oil and currencies. So as many different markets as possible, as many different time frames as possible, right? I day trade all day long. I trade the dailies, I trade the monthlies, I trade the weeklies for this exact reason. And then as many different strategies as possible. I want to trade as many different strategies, because at some point, maybe you trade one strategy, okay, fine, but that strategy may not be working, and so you'll have a different strategy that does. So not all strategies work at all times, so you want to have different strategies. I mean, right now, I trade 7 different strategies. Again, this is what I teach in my one-on-one. I teach you all 7 of these different trading strategies. There are some times of the year where one strategy doesn't work, but another one does. But so you have to have a tool belt. You have to have tools so that you can find I have in my strategy one strategy that works in a current market position. So this strategy here, actually on the deep dip buys and the island reversals and the fair value gaps, right? Different strategies. Well, this strategy here is a completely different strategy on CCJ. This is on the weekly. This is called a return to value V2. And first of all, let's take a look at the green line here, the green line here. Anywhere in this area between the low of this green line and the high of this green line, so this basically this channel, this is called the value zone. And what a lot of traders get caught up in is they buy above value. I rarely buy above this green line, because once it's above this green line, it becomes overvalued. I don't want to buy overvalue. I want to buy in value and sell above value. Or I want to, like with the deep dip buy, I want to buy below value and sell in value. Kind of makes sense, right? But what a lot of traders do, they get caught up in the noise, they get caught up in the news, they get caught up in the headlines, and they say, hey, things must be going really well for this stock or this market, I'll get in. Well, very oftentimes, once you get above value, it comes back to value, right? I mean, this is very clear. There are certain times of the year where something trends, and you're like, I wish I didn't have that rule. But overall, it's going to make you a lot more money and save you a lot more money if you, at the very least, buy in value and sell above value, or buy below value and sell in value. So again, green line here, this is the value zone. First requirement, you need to be above value. Well, this is clearly above the green line. Second requirement, you need to come into the value zone. Did that. Third requirement, you need to have some sideways motion. You need to see that there's some equilibrium between buyers and sellers. If you're going sideways, it means it's a fight between buyers and sellers, but no one's winning. And then you need a trigger. Well, the triggers that I use are called V1s, V2s. If you like, go to my YouTube channel. I have a video there on V1s, V2s. I learned these from Kerry Lavorne many years ago. I use V1s and V2s in my trading all of the time. They're a very important part of my trading. I talk about, looking for confluences, combinations of indicators lining up. I factor V1s and V2s into everything. They're not the main reason that I take the trade. Well, they are with a very formal return to value V1, V2 like this. Yes, this is exactly the reason I took the trade. But on deep dip buys, double bottoms, bullish divergences, all sorts of other stuff, they're not the reason that I took the trade, but they add bonus points to the trade. So in this particular case, it's a V2. A V2 consists of 3 bars: bar 1, bar 2, bar 3. The rule of this bar on a V2, bar 2 has to go below bar 1's low, or in other words, wash it out, go below, and then bar 3 has to close above bar 1's close. That's the rule. Above value, comes back into value, sideways motion. Once you have those criteria met, then a V1 or a V2 is your entry into the trade. In this is what it was. Bar 1, 2, 3, 2 washes out bar 1's low, 3 closes above bar 1's close. That's the entry. I got long here at 42.80. So when I get long and I decide to buy, first I have to position size based upon the volatility of the market and my account value. So I do that, I enter. Okay, now I always have 2 stops. I have an emergency stop, which is always 2 ATRs below. If it gets there, I lose 1% of my account, but that only happens about 5% of the time, in my opinion, in my experience. And then I have an end-of-day stop. Well, an end-of-day stop or end-of-week stop on this one is on a V1 or a V2 is a close below halfway of the washout bar. Remember that bar number 2 went below bar 1's low. That washes it out. So if I get a close below halfway of this bar, and this is this red line here at 40.80, I'm simply out of the trade. If I entered here, if the next bar would have closed below halfway, I'm simply out of the trade for a small loss, right? So return to value, sideways motion, V2 entry, position size, place my emergency stop 2 ATRs below, and my end of day stop a close below halfway. Then I calculate my entry price plus 1.5 ATRs. Remember, if it gets to 1.5 ATRs, now I go into trailing stop mode. And then if it moves up the value of 0.45 ATRs, the next bar, I'll take 10% of the position off right now. Right now it's $1.83. So I take the closing price, 48.10. I add $1.83 to it. That's my first profit target for next week for 10% of my position. Take the first profit target, add that again. That's my second profit target. I take my second profit target, add it again. That's my third. I always place 3 profit targets for the next bar. Okay, and we are in trailing stop mode. So I entered here. Next week didn't really do anything. Next week had a huge move up. What did I do? I hit 2 profit targets. I took 20% of the position off. So now I've reduced my position. I've locked the profit in. Market can't take it away from me. And I'm essentially moving up my stop loss, right? Because I am taking those off. Next week we went up again. I hit another profit target. And by the way, we're in trailing stop mode now. So now this means if I have a close below a previous bar's low, I'm just simply going to get out of the trade. You can see during the week, this was below the low. Had it closed below the low, what would I have done? I would have taken the remaining shares that I had and sold half because I got to trailing stop level and it had closed below. But this did not close below. Remember, I based this all on closing prices. So it kept me in the trade. Currently, this position doing well, up 11.04%. Really good, but it was perfect. Return to value, sideways motion, V2. I didn't know it was going to do this, but I did know that I waited for the proper setup to happen, and that if I'm wrong, I know what my maximum allowed loss is, and my end of week stop in this case is very close. That's all you can do. That's all you can do. And because I took off partial profits, I feel better about it, right? There's less stress, there's less heat on this particular trade. All right. So next week, if it moves up, like I said, the value of 1.83, because that's the value of 0.45 right now, I'll take another profit target off. If it goes up higher than that, hits the second profit target, I'll take more. Now, the key is, I was telling you about all these different rules. If right now we're at a 60-65 RSI. If I get to a 65 RSI, then the 5 EMA comes into play. In addition to that, if it goes higher, rejects the 70, I'm going to take half. And then if I have a close below a previous bar's low after rejecting the 70 RSI, take another half. Again, I know it sounds complicated. It's really not. You talk to my students, they're like, yeah, that sounded complicated at first, but yeah, now I know it like the back of my hand. So these rules are not hard. You just have to be taught them. All right. And again, earnings on the 30th. So regardless of whether it's down here, or it's way up here, it doesn't matter. I'll exit the remaining shares I have before earnings because I didn't know the earnings. But nice trade, up 11.04% on the weekly. LMT. All right, this is a closed position. This was not a winning position, but I from the trades that I've shown you, they're not all winners, right? But the common theme is that if they're losers, they're fairly small, and if they're winners, then they're probably going to be bigger. And that's exactly what I'm showing you. So I did get short here, Lockheed Martin at 456.30 back on the 29th of March. Why? Well, again, here is one of those fair value gaps. We have a high, pullback, higher high. Big move down, takes out the first swing low. What does that do? That changes us to bearish market structure. I waited until it got back into the fair value gap. I shorted at 456.30. I'm going to have my 2 ATR emergency stop above. And then where's my end of day stop or end of week stop? Well, if it takes out this previous high. Okay, and it did that on Friday, and I had to get out for a loss of 1.62%. But I want to show you something that's important. So I got short here, 456.30. Of course, my 1.5 trailing stop levels, or my trailing stop levels 1.5 below. The next week, it moved down, and I was able to take some profits. Okay, so at profitable levels, and I reduced my position size. The week after that, it went down again. I hit 2 profit targets at profitable levels. So I went from 100% to 10% here, 20% here, but it's a little less because there's fewer shares. But let's just call it 22% of the position I took off at profitable levels. Well, it moved against me this week. This would have probably been down much stronger this week, but because of the Middle East tensions, and this is a military contractor, kind of understand why it would be moving up on this Middle East tension, and that's probably why this trade didn't work. But the point is that before I had to get out on Friday, I was able to take some off at profitable levels, so it reduced my position size. So at the end here, when I had to get out, the partial profits mitigated this 1.62% loss, right? So again, not everything positive, but CCJ on the weekly still in the position, up 11.04%. LMT exited the position for a loss of 1.62%. Okay, before we start taking a look at the markets that I'm looking for potential setups next week, let's talk a little bit about trader psychology. I always talk about this. It's the most important thing, everyone. If you've been trading for a while, you'll know, unless you're superhuman, that this is a challenge for us mere mortal traders, right? It's very important that you get your mind right. And this post here by Akil Stokes, great post, by the way. Follow Akil at Akil Stokes RTM over on Twitter. And great channel. He's a great trading coach, has some really good products that he sells for trading, and I highly recommend it. I've been following Akil for a long time, but this is a great post, and he actually quoted from Alpha Mind 101 and from Stephen Goldstein, who I highlight a lot with trader psychology. So 2 great people, and Akil posted this, and let's see what he says. This quote is let's start with the quote. Every year, when I accept that I didn't know where the markets were going, I made money. Every year that I thought I knew where markets were going, I underperformed. Not knowing is powerful. Radically not knowing is even more powerful. Stephen Goldstein, Alpha Mind 101. Check that one out too. Akil says, this quote is less about your ability to make predictions and more about the humility that trades must have, understanding what we can only control, what we can control, and that isn't the day-to-day movement of the market, but rather consistently executing our edge. Oh, I guess this was quoted from Alpha Mind 101. Okay, let's unpack that. It's basically saying that Steve made more money when he didn't know where the markets was going, and he made less money when he thought he knew where the market was going. Why? Because he didn't have a bias. I'm telling you, everyone, if you have a bias of where you think the market's going, it's not going to work out as well. Why does it work out better when you don't know where the market's going? Because then you just follow your process. You don't have any overriding emotions or things pulling at you that says, well, this told me to get out of my short, but I think the market's going down. You know, I told you about a friend I had that had a very, very rough year shorting the market because they thought the market was going down, 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 down. Well, ultimately now they were right, but they had to go through a lot of pain and suffering that was needless because they didn't have to go through it, but they had an opinion about the market, and that's what kept them in the trade. So in other words, if you have an opinion, you're more likely to break your process. If you don't have any opinion, you're more likely to follow your process. And like I say every week, the thing that you need to do is not have opinions, not have biases. Wait for your signals, wait for your confluence of triggers to happen, position size correctly, know where your emergency stop is, know where your end of day stop, and just follow what it tells you. You're going to do better. So the takeaway here is get rid of your biases, get rid of your opinions on where you think the market's going to go. Have a good process, have a good trading process that incorporates, being very patient with your winners and very impatient with your losers, and you're gonna do better. Okay? So thank you very much, Akil Stokes, and thank you very much, Stephen Goldstein. You can follow Stephen at AlphaMind101, and you can follow Akil Stokes at Akil Stokes RTM over on Twitter. So thank you very much. Those were great posts, helpful for me, and I hope they were helpful for you as well. Okay, let's get over to the trades that I am looking at for next week. And again, they are not where they need to be. This is the process that I do on the weekends. I look at the charts. I know the levels that I'm looking at, and right now there's a lot of deep dip buy levels. Of course, I teach the deep dip buy stock trading strategy, and I wait for the markets to get to those levels. So let's look at the levels that I'm looking at currently at the moment. Let's start with Adobe. Well, Adobe looks horrible, doesn't it? Really, really looks horrible. But what caught my eye here is that we have a double bottom and a bullish divergence. I studied one-on-one with Dr. Alexander Elder. He teaches double bottoms, bullish divergences, double tops, bearish divergences, and he believes that this is one of the strongest indicators in technical analysis, and I agree, but we're not always there. We're not always in deep dip buy mode, but now we are getting there. So when I look at a deep dip buy by itself is fine, but if it has a double bottom bullish divergence, it's better. So let me explain what a double bottom bullish divergence is. Let's look at the lows over here. You see the deep red MACD bars? What does that indicate? That indicates momentum to the downside, clearly. But what Dr. Elder looks for is a low with deep red MACD bars. He looks for a little bit of a rally to where we get some green MACD bars, which we have here. And then we have to equal that low or go lower, which we did here. And you see how this MACD bar is much, much more shallow, not as deep as over here. Okay, this means we have a double bottom bullish divergence. All this means is that this second move down did not have the momentum of the first move down, and it's implying that you're running out of sellers. And if you run out of sellers, the implication is that you're going to move up. When a market's run out of sellers, it moves back up. When it runs out of buyers, it moves down. Okay, but just because you have a double bottom bullish divergence does not mean you can just jump into the trade. you still need a trigger. You still need something to calibrate and structure your trade with. Well, right now, so we agree here. We have a double bottom bullish divergence, which is positive, but I still need the trigger. Well, you know, in my deep dip buy course that I teach in my private 101 lessons, and also on udemy.com, by the way, it's a great course. I've sold so many of them around the world. The link's in the description of the video for the Udemy course. This is looking very, very interesting to me. We're at a 29.62. Well, for a deep dip buy under 30 over 30, all I would need is a move back above the 30 RSI. Okay, under 30 over 30, legitimate signal, but it's even a better legitimate signal because overlay on this the double bottom with the bullish divergence. We're near the negative third ATR channel. We're under the 30 RSI, but we have this double bottom bullish divergence. So this is quite interesting to me. I mean, look, want to buy up here? Overvalued? Well, now it's on sale. All right. Nobody likes to buy stuff on sale, but I do like to buy things on sale. But I still need a valid signal to get me in. Well, double bottom bullish divergence, good to have, great to have. All I need is a move up with a close above the 30 RSI. Position size, place my emergency stop 2 ATRs below. Where would my end of day stop be? Well, if I took the trade because it's under 30 over 30, then if it closes below 30, I'm simply out of the trade, right? Right away. If I'm wrong, I'm wrong. I'm probably going to be wrong small. If I'm right and we get a sustained rally up here, then I can potentially have a big trade. You're going to have a lot of losing trades in trading, but the key is you keep them small. And you need several big trades to pay for all those little losing trades and more so that you have profit. So that's what I'm looking for next week, is simply a close over the 30 RSI, a gentle close. If it moves way up here and gets to like a 44 RSI, I'm not going to do it because then the risk to reward is not good. Ideally, this closes at $30.01, or RSI is 30.01, right? That would be, or 30, just closes at 30. That would be your best risk to reward ratio, because the next day if it closes at 29.99, you're simply out. Okay, so double bottom bullish divergence, I like it. I just need the trigger. I'll potentially look at buying Adobe if it closes over 30 RSI. So that's Adobe. Caterpillar. Okay, I showed you on CCJ, great trade that I had on CCJ, return to value V1 or V2. Okay, this is formatting for this right now. Remember the rules. First, you close above the value zone. Remember, green line, green line. Anywhere in here is the value zone. Did we close above the value zone? Clearly. Did we come into the value zone? Clearly. Third requirement, do we have sideways motion? Clearly. Above value, return to value, sideways motion. Does that mean we buy it? We still need the trigger. What's the trigger on a return to value? It's a V1 or a V2. So this is formatting perfectly on Caterpillar. Bar 1, bar 2. Bar 2 goes below the low of bar 1. Bar 3 would need to close above bar 1's close. That would be a V2. So Monday only, if Caterpillar closes above 356.63, we would have a return to value, sideways motion, V2 entry. I position size, place my emergency stop 2 ATRs below. And again, what's my stop on a V2 entry? Halfway of the washout bar. Well, that would be pretty dang close. It'd be about right here. Talk about a good risk to reward ratio and being out quickly if you're wrong. And if you're right, you come back up here. I mean, yes, Caterpillars come down with the rest of the market, but the relative strength of the Caterpillar is much better. So above value, return to value, sideways motion, a legitimate V2 entry would occur on Monday if it closes above 356.63, and it gives you a great risk to reward. It gives me a great risk to reward ratio. The only thing with this trade, though, if I'm in it, I'm probably only going to be in it 5 or 6 days because earnings is on the 25th of April, in which case I always exit before earnings. So nice, perfect setup on Caterpillar, but we needed to get above 350 or close above 356.63 first of all, and that's Monday only, by the way. Carnival, CCL. Okay, well, Carnival has taken a shellacking clearly, But from a deep dip buy level, we are at some interesting levels. You know, for deep dip buys, my levels are the black line, which is the 200, the purple line, which is the 250, and now we are down to the 300. We are way down here. Well, for a deep dip buy on CCL next week, all I would need is a close above this green line, this orange line. You can see we made a low, we rallied up, gave it back, closed under the 300. We're under the 300 again. Next week, if I get a close above the 300, I would like it even better than a lower low, because this would be a higher low. If Monday we closed above the 300, you see how we have this higher low in place? This low is higher than this low. Lower lows tend to bounce and fail. Higher lows tend to trend more often than lower lows. And lower lows do exactly this. Lower low, they rally, they fail. Lower low, they rally, they fail. Higher lows tend to trend. So I'm going to keep my eye on CCL. I'm just looking for a nice gentle close above that 300-day moving average. Just closes above there, position size, emergency stop 2 ATRs below, and just a close below the 300 would be my end of day stop. And if it just closes below, fine. I take a little loss. But if we rally, I have the potential for a big gain. So that's what I'm looking for on CCL next week, is a nice gentle close above the 300-day moving average. The Dow. Okay, well, now we are looking at the indexes. You know, this move down is incredible. But you see, I've highlighted the blue box here. Why did I highlight this blue box? Well, this is where we had a structure change to the upside and a fair value gap. Going back to fair value gaps. Right here, we're above it, coming back down into it. Do you see how DIA has held this level? It's pretty interesting, right? That it got right to that fair value gap, and that's where it bounced. So for me to get interested in buying this, where am I interested in? What I am interested in is the bottom of this fair value gap. Why? Because if I have the bottom of that fair value gap, then I have the best risk to reward, because if it gets to the bottom, what is that, 375.40? That would be my entry point. Where would be my stop? Simply a close below these low back here in January. So let's just say on Monday, for example, it gets to 375.40. I would consider taking the trade. We'd be in the low 30 RSIs, and more importantly, would be at the bottom of this fair value gap. This fair value gap should hold, but my stop would simply be a close below the low there of 371. So that is what I'm looking for. In addition to that, under 30, over 30, not, you know, the Dow was actually up on Friday. Yeah, I'm glad to see that on some indexes there's some potential entries. I've stayed away from them for weeks and months, as you've known. I said I'm not buying up here. I'm waiting for these things to go on sale, and we are getting back to some interesting levels. So on DIA, what I'm looking for is 375.40 for a potential entry. Home Depot. All right, well, we're coming to some important levels right here. We are definitely coming to some important levels. This 200-day moving average, the black line down here, you know, obvious, sticks right in your face. That would be a very good place to structure a potential trade. It doesn't mean that it would work, but what am I looking for? I'm looking for three things on Home Depot. I'm looking for a rejection of the 200-day moving average, the black line. What do I consider rejection? One would be a close under, close back over. That's a rejection. An intraday rejection where it goes below, closes back above, or simply a bounce. This 200-day moving average right now is acting a bit of a magnet. I'm not buying because it hasn't got here, okay, or tested it. There's thousands of other traders that are thinking the same thing. I'm not buying until it gets there. If it does get there and reject it, I may get in, right? And there's thousands of other traders that might get in. Well, it's almost a self-fulfilling prophecy, isn't it? But I want to see that it rejects this 200-day moving average first. And if it does, let's just say Monday it goes below, closes back above. Okay, I might consider taking the trade. Where would my stop be? Well, just simply in the future, if it closed below the 200-day moving average, I'm simply out. or most likely a small loss. At the very worst case scenario, I have my two ATRs below, right? And we might turn into a rally. I mean, I think we're due a rally. I mean, we may get up in here, so I may be risking, 1% to make 3% or 4%. Makes sense. So that's what I'm looking for on Home Depot, is some kind of rejection of the 200-day moving average. IWM. All right. Well, IWM has come way, 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 way down. Way, way, way. Brutal. What am I looking for? It's the same thing I'm looking for on Home Depot. I am looking here at the 200-day moving average. Let's look in the past. Was the 200-day moving average respected in the past? It certainly was. Look at this. Close under, close over. Had a huge rally. When you're looking at a moving average to consider if it rejects at that moving average and whether you're going to take the trade, look in the past to see if that same moving average was respected. Well, it was over here. Does it mean it has to be this time? No. There's several different areas here on IWM. There's the 200-day moving average, the black line, the 250, the 300, which is the orange. So anywhere in this level, it's very likely that it will hold. It may not hold, but there's some key levels here that large financial institutions are going to key off of. In addition to that, we're at a 3336 RSI. One of the best confluences of combinations of indicators lining up is a multiple of a rejection of a major moving average and a rejection of the 30 RSI. One of the best you can get. Well, if we come down and test that 200-day moving average, depending on how quickly, we may also reject the 30 RSI. That would be a key level of a rejection of a 30 RSI and a 200-day moving average. Doesn't mean it's going to work, but it would give you a good structure, give you a line in the sand of how to structure your trade. Over the 200, I'm in. Under the 200, I'm out. Pretty easy. It's pretty easy, right? When you boil it all down, it's pretty easy. Above 200, in. Below 200, out. That's really how I approach trading, right? And then you have to take your profits, get to trailing stop level, all the stuff that I trade. But it's not there yet. If it gets there, I'll consider taking the trade. If it doesn't, it just moves up. Great. Good for the people who own IWM. So IWM, rejection of the 200-day moving average, ideally rejection of 30 as well. Morgan Stanley. All right. Well, this is a short trade. Why? Again, let's talk about fair value gaps. We have high, followed by another high. We have a huge move down that definitely breaks market structure to the downside. Okay. And then we've had this counter rally. Where would I get short? What I'm looking for to get short next week for Morgan Stanley is somewhere in this blue box, because we're very high. Did this move down mean something? Oh yeah, it certainly meant something. I promise you. And now we're coming back up. I'm going to be patient somewhere, just like on the PayPal, the exact same trade as PayPal. And I'm looking for, I may not wait for the top of the gap. I may add a little here at the bottom, maybe a third at the bottom, a third in the middle, a third at the top. Not sure. I'm just going to have to see what the price action looks for. But to me, this looks, I could be wrong, but this does look like this is going down. And this is supported by the huge break in market structure. So if I get short next week somewhere in this blue area, where would my stop be? Just the first swing high right here. Close above that swing high. That would get me out of the trade. That would change the market structure. So back to the upside. So just being very caged. And this is an order block too. An order block, again, I teach, this is my lesson. This is ICT stuff as well. This is a move up, a high bar before market structure change. And so the low of that order block, the high of that order block is also serious resistance. So in a way, you could really even draw the entire shortable area as here. Okay. But what I'm looking for is just someplace in this blue area. I wish I could predict it, but I'll see it when I know it. I'll know it when I see it. Okay. But this is the area that I'm looking in for a short. NVIDIA. Okay. Well, I was told this stock was never, ever, ever going to go down. Were you guys told that? That's what they made it seem like. And for a while, that's what it felt like. But it gave up the ghost on Friday. So, what are the key levels on this? Well, back here on the 22nd of February, we blasted above here, leaving this huge gap. This is a fair value gap. This is a bullish fair value gap. Ideally, I want to buy somewhere in this blue box. This is difficult. This is very difficult. My ideal would be here at 689. Okay, about 80 points below. Can it get there? It certainly could. The high of this order block would also be legitimate, 739. But this is a lot of range to contend with. So first of all, I need to get somewhere in this blue box to even consider getting long NVIDIA. We're at 3402 RSI. So if we do come down further, if it extends its move down further and gets into a 30 RSI level, that very likely will happen in this fair value gap. Remember, this fair value gap, theoretically, it's legitimate to buy anywhere in this fair value gap. So what I'm looking for is a combination of an under 30 over 30 is legitimate by itself, but if the under 30 over 30 happens inside of this fair value gap, well, that adds credibility. So I wish I could be more specific on what I'm looking for here. Well, I guess I am specific in the fact that if it does go under, if it does reject the 30 RSI, I probably will consider taking the trade, especially because it's here. If it closes below 30 RSI, it's still a potential to buy because you're in the fair value gap. If it gets to the low here, 689, heck yeah, I'm definitely buying NVIDIA there, right? Because my stop would just be a close below this low. Don't know if it's going to get there. So, NVIDIA is not making it easy, but there are some important levels. 30 RSI is an important level. This fair value gap here is an important level as well. So I'm just going to have to play it by ear, everyone, and kind of see what this does. But I know from experience we are getting into some interesting levels. Qs. Okay. This is very similar to NVIDIA. See the highlighted blue area. Why? Because there was a fair value gap here when we broke out of this new high. This makes it interesting just by itself. Technically, this was a legitimate buy on Friday. I didn't buy it, but this is a legitimate. But look, we're at 29.65. And under 30, over 30 on the Qs, historically, that's a good entry. Have we had a pullback? I would say. But exactly what I was talking about on NVIDIA, it's not there yet. Fair value gap under 30, over 30. Yeah, that could be a very compelling trade. But on Qs, we're right there now. If we go up on Monday, we'll have an under 30 over 30, and we will have rejected the bottom or the top of this fair value gap. If we go into the fair value gap and close back above, that's compelling. But an under 30 over 30 at the same time, that's super compelling. So I'm watching this one very close, everyone, looking for an under 30 over 30. If we have an under 30 over 30 on Monday, I very likely will take the trade because it's an under 30 over 30 and because it came down to this fair value gap and bounced. I want to point out here, I'm not tooting my own horn, but sometimes after the fact, when you look at these, they're very, very clear. For the last 3 months, I have not touched the Qs up here. Why? You've heard me say many, many times, look, we're going higher and higher and higher and higher, but it's not confirmed with MACD. We have bearish MACD all the time. Look at this high. Look how high the green bars are. Now we're higher. They're not as tall. Now we're higher. They're not as tall. Now we're higher. They don't even exist. This was showing that you were running out of buyers. The momentum was waning, waning, waning. What happens when you run out of buyers? You go down. What happens when you run out of sellers? You go up. So everyone was just, super excited. FOMO at its highest up here. That's why I was so not willing to buy things up here. And after a while, you're like, man, I just must be wrong. But the indicators just don't lie. But now it looks scary. Now no one wants to buy, right? Now no one wants to buy. I've talked to people last week that were very hip on buying up here. And now here, they're like, I don't know. Could go down more. Could go down more. Well, it could. But I'd rather buy here than up here. So everyone wants to buy up here at the top. No one wants to buy when it's on sale. Well, it's on sale now. You can make a lot of arguments that it's going to go lower. It's true. It may. But you can also make the argument that we technically are in a very interesting fair value gap here. And with an under 30 over 30, that's legitimate. If it goes over 30, potentially get in. Just closes back under 30, okay, I'm out. That's it, right? That's it. So very interesting trade for me here, potential trade for me on Qs if we close above the 30 RSI. Shopify. All right, some interesting levels on Shopify as well. 200, which is the black line, 250, which is the purple, orange, it's 300. Okay. Interesting about Shopify, I was talking about relative strength. Look, it was up 0.23% on Friday. Interesting. Market got crushed and it was up. Well, that gives you a little clue. That gives you a little clue that maybe this is stronger than the rest of the market. If the market had been up on Friday, Shopify I'm sure would have been up much more than the rest of the market because it was up when the market was down. So what levels am I interested in here? Well, just back to deep dip buys, right? 200-day moving average, 250-day moving average, 300-day moving average. I'd like to see a rejection of the 200, some kind of rejection, close under, close over, intraday rejection or bounce at the 250, at the 200, 250, or 300. In addition to that, we're at the negative third ATR channel. It's not a reason to take a trade by itself, but 92% of times when you get to the negative third ATR channel, it stops going down or goes up. So we're coming into that confluence of negative third ATR channel, major moving average levels, and low 30 RSIs. This is an interesting place to start thinking, but I still need the trigger because what does the trigger do? The trigger, once it triggers, then it gives me the structure on how to place my stops. Without that, I don't really have it, right? So that's Shopify and SPY. Okay, in my one-on-one course, obviously I teach deep dip buys, right? But this is a confluence that rarely happens, and it happens so infrequently that I rarely talk about it. But it's happening, and that confluence is an under 30 over 30 at the same time you get to the 100-day moving average. I talk a lot about the confluence of the under 30 over 30 at the same time you have an under 200 over 200 or under 250 or 300, right? That happens more often. And that's a great signal. But this is also a great signal, but it happens so infrequently. You need such a quick move down. The only time you'll ever get this under 30 or rejection of the 30 RSI at the same time you're at the 100-day moving average, which is the red line. You need such a huge move down for that to happen. Well, that's happened. So what I'm looking for on SPY next week is right here, a rejection of the 30 RSI at the same time I reject the red line, which is the 100-day moving average. So, whether it's SPY, whether it's diamonds, whether it's Qs. I can't say for sure, but I can whether or not we're going to hold here and have a bounce. My guess is yes, because we're coming to all these major levels. We may not, we may head back down, but the important thing is being patient and waiting. And if you're patient and waiting, people that haven't been long this market, now it's probably going to be interesting to them. So we'll see what happens. All right, let's go over to, and again, everyone, just before we switch over to the weeklies, again, I have 11 symbols here. Theoretically, on Monday, all 11 of those could trigger. Does that mean I'm going to take 11? No. Out of those 11, I'm going to narrow it down to the very best one. Again, how do I do that? Which one has the multiple, which one has combinations, confluences of indicators lining up? Which one has the best risk to reward ratio? Which ones have double bottoms, bullish divergence compared to which ones don't? Which ones look better on higher time frames? Which ones have better relative strength? Again, this is what I teach in my one-on-one course. It's not just about learning a strategy, because I can have the same strategy in 4 candidates, but one can look better than the other. Again, in addition to all the strategies that I teach you, I also teach you how to narrow down to the very, very best candidate. All right. So again, if that's of interest to you, my email is in the link in the description. Reach out to me. Be nice to meet you. I generally have a Zoom call with a prospective client just to make sure it's a good fit. But you're going to learn a lot, and I know you're going to be a better trader. Let's go over to the weeklies. Only one, I believe, on the weekly. Only one. And it is Adobe. I had Adobe on the daily as well. If you remember, we have the double bottom bullish divergence. I'm just looking for a trigger of a close over the 30 RSI. That's the potential trade for me on the daily. But on the weekly, let's just say we go down. Let's say we don't get it under 30 over. Let's just say we head down even further. Well, there are some key levels on the weekly here on Adobe. We're at the negative third ATR channel, not enough to take the trade, but I do know that being at the negative third ATR channel generally indicates close to a bottom. If it goes lower, what I'm looking for here, look at the purple line. This is the 250-week moving average. If we get there, most likely we'll be at a 30 RSI on the weekly. That is a very interesting place. Or even lower here at the 300. I think we are within somewhere between 10%. That sounds like a safe bet, right? But yeah, I mean, the market's been really crazy, but I do feel pretty confident about buying Adobe at the 250-week moving average or the 300-week moving average, as long as it rejects it, right? If it rejects it, then I can plan my trade with a good risk to reward ratio. It doesn't have to work, but I know I have a good risk to reward ratio. So on the weekly on Adobe, the only weekly trade that I'm interested in next week is some kind of rejection of the 250-week moving average and the 300-week moving average. Yep, that's all I got. So mentioned this at the beginning of the podcast, everyone, but if you're enjoying something here, if you're finding some value in what I'm teaching, I really appreciate it if you could hit the thumbs up button. Again, if you're interested in private one-on-one lessons, I teach a 15-hour course. It's a very intensive course. I teach all of the 7 different trading approaches that I use. I teach them step by step. We do lots of simulations. When you're done with this course, you will know how to trade. You will know how to trade like I do, and I think it's really going to help you in your trading. So again, my email is in the link of the description. Just send an email to me. The course is 15 hours, 5 sessions. Each session is 3 hours. The cost is $1,750, but one-on-one, I believe, is the best way to learn anything, and especially with someone with my experience, it's a really, really good value. It's worth every penny. So if you're interested, just send me an email. An alternative to the one-on-one course is my Udemy course, where I teach you step-by-step how to trade the deep dip buy approach. It's a great approach. I've sold so many around the world. I think I have like 4.8, 4.9 stars. It's very, very affordable. It's 9.5 hours of video, 26 videos, And it's a great place to start if you want a little coaching or a little instruction on how to trade that strategy. The link's in the description. And I always like to leave off with, please try to go out and do something nice for someone today. Do something nice for a human. Do something nice for an animal. If we all did that, it would make the world a lot better place. But please be careful next week. The market's very, very volatile. But again, I feel like we're getting some interesting levels. Try to get your head out of the news and the headlines and just follow your levels. That's really all that matters. Remember what I said from the trader psychology section. Don't have an opinion on where it's going. Just let the market tell you what it's going to do. It's a much better guide than your opinion. But I really appreciate you being here, everyone. Hope you have a really good rest of your weekend. And God willing, I will see you next week. And on the way out here, I have to run the U.S. legal disclaimer. Thanks so much, everyone. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.